Like I was saying, we're going to look into interest rates. Now, before I go further, when we talk about interest rates, what are we referring to? Remember, in this webinar, we're going to be talking about the importance of interest rates in Forex trade. And like I was saying earlier, right, it's important that we realize the major objective behind our trying to trade. We're trying to make money, we're trying to make extra income. That's what we're trying to do. And in trying to make an extra income, as traders, we must buy assets that we expect the prices to rise. And for assets that we expect the prices to fall, we must sell it. That's the whole idea. Now, that expectation comes from your understanding of what is driving or influences price. That's the only way you can make such conclusions or make such, decisions. Now, the drivers, like I always say, could be policies, could be the economy, could be geopolitics, could be commodity prices, could be market sentiment. It could be a number of things. But in today's class, we're going to be focusing on the policy side and by extension, interest rates. Now, I'm going to quickly cross over to my screen where I have the notes for us, and then we're going to get started. Now, interest rate. What exactly is interest rates? And then what is it about? Now, interest rates, when we talk about interest rates, right? Interest rate is simply the cost of capital. Simply. Interest rate is simply the cost of capital. That is, as a trader, when you want to trade, we'll get into how it affects traders, but when whatever you're doing, you take a loan, of course you pay an interest, right? You invest, you buy fixed income assets, of course you earn interest. It's just the cost of capital. Now, for every single economy, for most economies, the central bank is in charge of setting the main interest rates in that country, right? I'm saying most so that I don't just generalize, but for majority of everybody, the central bank is in charge of setting the interest rate. Now, of course, the interest rate is set by the central bank, right? And that rate is what we refer to as benchmark rates. It is that rate that determines how other rates in the economy, right, would be. That rate affects every other rate in the economy. Now, this interest rate is very important because it affects the currency value, it affects how investors see the economy, it affects demand for the country's currency, and a number of other things. And that is why today we're looking at these interest rates and how it relates to forex trading and make how we can make decisions based. On the board, I said that interest rates are very important economic indicators, right? For traders, central banks use this interest rate to control inflation. It can also be used to stabilize the currency value. It can also be used to control the economic growth in general. As a matter of fact, when traders are trying to trade, we look at every other economic indicator, right, in the same light of interest rates. That is, we're trying to see how unemployment affects interest rates. Whenever we have inflation data released, we're looking at how this impacts interest rates going forward. It's very important that it covers or it forms the core part of our daily analysis, weekly and monthly analysis, and our decisions as traders. Because whatever the interest rate is, or whatever the central bank is doing with interest rate, can affect the value of the currency over time. And it's important that we as traders also understand this and pay attention to this. You see, when you're trying to trade, you can always look at the long-term direction for currencies. What we talk about fundamentals. As a trader, you must have heard about fundamental analysis, sentiment analysis, technical analysis. Now, the idea behind fundamentals come out of or are formed based on the overall economic performance and the central bank monetary policy stance. This monetary policy stance, a big part of it is interest rate. And if you want to know how a currency will trade over time, over the next couple of weeks or the next couple of months, interest rates can help us with that. Interest rates helps. So it's important that we pay attention to the interest rate and then look at how it affects different aspects of the market. And I said traders closely monitor these rates because the whole idea is it reflects the overall health of the economy, and it can also, the part that concerns us as traders, it can also influence the price of the currency. One of the things that you want to know as a trader is if you want to know where a currency is likely to trade over the next couple of weeks or months, that is, if you want to know whether a currency will keep rising over time or it will keep falling over time, one of the things that you want to pay attention to is the interest rate. Because whatever the interest rate is, or whatever the central bank is doing over time, it can influence the currencies higher or it can influence the currencies lower. And once you can figure that out and you know where a currency is headed over time, of course, that can provide you a solid trade idea that you need to even hold for a while. Central banks often use interest rates as a tool to regulate the economy. Central banks often use interest rate as a tool to regulate the economy. Now, interest rate is not the only part of monetary policies, no, right? Central banks have a number of tools, but interest rate seems like the one that you pay attention to the most and the major go-to tool of central banks. When central banks reduce the interest rate, it's usually helping to boost productivity in the economy, stimulate the economy growth. But when inflation is getting out of control, central banks tend to increase this interest rate to try and curb or control this inflation. So, as a general tool, interest rates help the central bank regulate the economy by controlling inflation when they increase interest rates or by stimulating economic growth when they reduce interest rates. When central banks are in a cutting circle, when they're looking to cut interest rates, when they're reducing or decreasing interest rate, it helps to stimulate the economy. How? Because now the cost of borrowing is much lower. Consumers and businesses can now borrow more, right? Because now the rates are lower. This will help boost retail activities. It will help boost spending. And by extension, it will help the economy grow. But of course, the interest rate can be looked at as a regulator because if you cut it too much as well, and economic activities are increasing too fast, right? At some point, inflation will start to pick up, and inflation must not become too much as well. In a case where inflation is getting out of control, the central bank has to come back to interest rate and increase interest rate to try and slow inflation. But of course, that would also slow economic activities and also slow economic growth. So the idea is interest rate is like a measuring bar, right? A thermometer, or I don't know how to put it, but it's a major tool that central banks use to make sure, ensure the economy is doing okay. Now, this inflation that we talk about, right, is one of the major factors that central banks look out for in order to determine what they do with interest rates. And as traders on the economic calendar, we can see different measures for inflation, which can help us know what central banks are likely to do with interest rates going forward. You have things like consumer price index, CPI. You have things like producers price index, PPI. And for the US, you have the PCE, that's the personal consumption expenditure. These economic data points, right, show us what inflation is, and by extension, can tell us what the central banks are likely to do or give us an expectation of what we should do or expect from the central bank. How do interest rates directly affect the value of currencies? This is the part that concerns us majorly as traders. How do interest rates directly affect us, affect the value of the currencies? That if I know what the interest rate is, if today it's 2%, how does that affect the value of the currency? If today it's 5%, how does that affect the value of the currency? I think by extension, it's not just the interest rate number, it is the path for interest rates going forward. If the interest rates are currently increasing or expected to increase, what it does is it attracts foreign investment because foreigners can simply bring their money to your economy, put it in a fixed income asset, and earn higher interest. This, of course, increases the demand for the country's currency. And when demand increases, the price or the value of such asset goes up. So by extension, when central banks are increasing interest rates, or when markets expect the interest rates to increase going forward, it increases the demand for the currency, and by extension, it increases the value of the currency. So for example, if you have the US Federal Reserve, that's a central bank, looking to increase interest rates, have already increased interest rates or are planning to continue to increase interest rates. Of course, that would mean that the value of the dollar is expected to appreciate. And as a trader, you are expected to buy. Because when you buy a currency, that the value is expected to rise, and the value rises, of course, you will have made a profit. On the other hand, when central banks are in a cutting circle, they're cutting interest rates, reducing interest rates, usually because the economy needs some support. But when that happens, of course, it discourages foreign investors, right? It discourages saving, it encourages borrowing, right? It basically increases the amount of money flowing around in the economy and reduces the demand for the currency from foreigners. When that happens, of course, this causes depreciation in the value of the currency. I think let me adjust something in the notes. Right, depreciation. Right, thank you. So whenever central banks increase interest rates or they're planning to increase interest rate, you expect the currency value to rise. As a trader, you want to buy them. Whenever central banks are cutting interest rates, looking to cut interest rate, only planning to cut it, or their tone is tilting towards cutting interest rates, or they're being more receptive to the idea of cutting interest rates, we expect the value of the currency to fall. And as a trader, we want to sell it. So currencies with higher interest rates or currencies where the central banks are increasing rates, traders buy them. But currencies where the central banks are cutting interest rates, traders sell. I hope this is clear. All right. Now, how do we know what the central bank is likely to do with the interest rate? And before I go into that, if you want to buy these currencies based on higher interest rates or increased interest rate, where how long do trades like that last? Firstly, to know what this interest rate is, of course, you can check. On the economic calendar, you can check what the current interest rate is for all major economies. It's something you can check online if you search for. The central bank websites of each of the major central banks have that information. And from time to time, these central banks meet and have a meeting where they discuss the current economic situation and what they think is likely to be going forward and what they should do with interest rate. They discuss these things. For some of the central banks, these meetings hold every month. For some, every 6 weeks. For others, every 2 months. But then they discuss these things. In this meeting, the central bank monetary policy committee sits together. They talk about the economy. How is our economy faring? What is currently going on? How far away are we from our objective or our target? What is the current economic forecast projections? Do we need to increase the interest rate? Do we need to leave the interest rates unchanged? Or do we need to cut the interest rate? So usually there's a vote. And based on that vote, the central bank comes up with a decision on what to do with interest rate. Whether they increase it or reduce it or leave it unchanged, markets cannot attend the meeting. But after the meeting, the central bank releases a statement that details exactly what they have talked about, what they think about the economy, what the future projections are, and what they have done with interest rate or what they plan to do with interest rate going forward. Of course, you can find this from the central bank website and even any of the many research platforms that we always share with our clients. Through the statement, we can know what the central bank is doing. A lot of times, after the statement is released, we usually have a press conference where the governor, president, or chairman of the central bank comes out to talk with the market or just give a press conference, detailing or explaining what they have done, why they have done it, and what they plan to do going forward. Of course, this is with the press, so they get to take questions and answer that. But then it gives traders more insight into why the central bank have done what they have done and what we can expect going forward. Not just that, from time to time, central bank members often have engagement that the media also covers, where they give speeches at different economic events or even other market events. But then from these speeches, we can also pick what the central bank is doing or what they think or what that central banker thinks about interest rate going forward and what they're likely to do when the next meeting comes up. These are the ways that we make these decisions. A lot of times, too, after the central bank meeting has passed, maybe a week or two after, or some days after, the minutes of the meeting is released. Of course, it's in the minutes of the meeting that you can now know the details of what was discussed in the meeting. From all of these engagements, traders can pick out clues and know exactly what is going on with the central bank and what they're likely to do going forward. These are one of the ways that we can tell what is going on from the central bank, because you see, the central bank of any country is responsible for regulating the economy through its policies. And like I said already, interest rate form a major part of these tools. For most of the central bank, you see, their major objective, their major goal is price stability. They do not want a situation where inflation is too high or where inflation is too low. For central banks like the Federal Reserve, that's the central bank in the US, like the Bank of England, even the European Central Bank, they have a 2% target for their inflation generally. That is, they usually want inflation to remain within that range of 2%. If it's going too high, above 2%, then they want to increase the interest rates to keep inflation back under control. If it's falling too low as well, they also want to cut the interest rate to try and stimulate economic activities to get it back on track. So they try to monitor inflation data to help them with the economy. But not just that, they also pay attention to what we call full employment, that is the jobs aspect of the economy. Whatever is going on with the job, because jobs also give a very good clue on what is going on with any economy. When the job situation is increasing or improving, when people are getting more jobs, of course, it affects the currencies positively. It's a good sign that companies are doing well, and then they can, by extension, pay more. The stock market will boom. All of these things hire more, people get more jobs, money flows to the economy, things can flow. So when central banks look at it, that's where economic data comes in, because the economic data helps us to know what the economy is doing. And because central banks also pay attention to these things, we as traders should also pay attention to them. Two things I want to spell out. See, one thing I want to help you understand is it is not only when central banks increase the rate. So I'll give you an example. Let's say today, the Federal Reserve in the US are expected to have their meeting. And then after the meeting is done, they release the statement. And in the statement, they increase the interest rate. It is not at that point that price starts to rise, not necessarily. And the reason why I'm saying that is traders are forward looking, markets are forward looking, and usually the expectation alone is enough to drive volatility in the market. Whatever we expect the central bank to do with interest rates can already tell us or even provide trading opportunities. If markets perceive that the central bank is likely to increase interest rates in their next meeting, we would have started buying the currency from now. It is not until the central bank actually does the increase that prices start going up. Prices would have started going up earlier already. Market expectations are very, very important. And as traders, we must absolutely not ignore that. So it's not only, the same thing even goes with data as well. It's not only until you see the central bank take an action or make a decision before the currencies of markets start to react. Markets can react way longer than that. So expectations are also key. And that's why when data comes out, markets adjust their expectation for what they expect the central bank to do. And that is what now continues to drive prices. So one thing you must pay attention to is the expectation. Whatever the expectation is, it always plays a big role. So that means that if data keeps printing positive, so for example, today we're trying to trade and then we're looking at the calendar, data like unemployment or inflation comes in positive for the currency, markets start to expect the central bank to be more on the tighter side of monetary policies, increasing interest rates in that light. That in itself can make the currency start to rise. Oh, data is coming out more negative. Of course, that also affects market's expectation for what the central bank is likely to do with interest rates going forward, and it can also weaken the value of the currency. So when it comes to interest rates, it's not only about what the central bank does. As a matter of fact, before the central bank makes a decision, markets already have a forecast of what we think they will do. And usually that is already priced in. For example, next week, the Reserve Bank of New Zealand, next week, I think on the 27th thereabout of November 2024, the Reserve Bank of New Zealand is likely to, they would have their meeting, and we expect them to cut their interest rates by 0.5%. Usually, when it comes to central banks and interest rates, we talk about it in what we call basis points. So you hear things like 25 basis point, 100 basis point, 50 basis point. Now, basis points are simply another way of talking about percentages, right? Where 1% is equal to 100 basis points. So the way I'm saying that the central bank in New Zealand are expected to cut or reduce their interest rate by 0.50%. What I'm saying is they're expected to cut interest rates by 50 basis points. Now, that said, that is the expectation. And usually markets are correct because before this expectation is formed, we would have considered data, considered central bank communications, all of that ahead of time. Before the meeting, all through this month, mostly we've had weakness in the New Zealand dollar in anticipation of that. If when the meeting happens, the central bank comes out and cuts the rate by 50 basis points as expected and do not give us any clues or signs that they are likely to do more interest rate cuts going forward, the currency may not fall on that day. The fall in the weakness that we should expect would have been happening prior to the meeting. It's only if at the meeting they also give us clues and signs that they are likely to continue in this path, maybe even more than markets expect, that you can now see another round of selling in the New Zealand dollar. Do you understand what I'm saying? So it's not only about what the central bank does at that meeting, it is expectations heading into the meeting that drives prices most. Fundamental trade ideas. Now, I like this part because it also helps us a lot. What do I mean by fundamental trade ideas? Knowing what the central bank's path for monetary policy is and interest rate can help you as a trader form a medium to long-term bias for any currency or any asset. You see, central bank's monetary policy guidance or interest rate path or direction does not change overnight. If a central bank is in the hiking circle, that is, they're looking to hike or increase interest rate, right, and they start that path or that circle, that is likely to run for a lot of meetings. And don't forget, I said that these meetings could hold once a month, once in 6 weeks, once in 2 months in some cases. So that means that if the central bank is increasing interest rate, they're likely to remain in that path for some months. By the time they have done it, before they even start cutting interest rate, they'll first go into a period of leaving rates unchanged for a while. Maybe another 2 to 3 meetings before they now start talking about cutting interest rate, except there is a drastic change in the economic fortunes in that particular country. But generally, it takes a long time for central banks to change the policy direction fully. So that means that if you can figure out the part of what the central bank is doing, what they're likely to do for the next couple of weeks and months through their communication and the interest rate, you can hold that currency for a while. I'll give you an example. Over the last 10 years, basically, or even more, going back to 2010, 2011, 2012, I can't remember exactly, but the Bank of Japan had kept or maintained a loose monetary policy where their interest rate was in negative region around 0 points. I can't remember now, but in negative region. As long as that factor remained in place and the central bank did not show any clear signs of change that anytime soon, the currency had weakened over that period. Yes, we'd had periodic times where it strengthened, we'd had periodic times of currency intervention, we've had periodic times of retracement, but over the long haul, the currency had weakened. For the US dollar now, over some months as well, we've had a situation where the central bank, when they started tilting towards increasing interest rate or they started increasing the rates, of course, the currency had been going up. You see, by understanding what the stance is, you can hold your trades for a longer period of time. I'll give you a quick look about where interest rates are across the major economies and then what we should be doing or what the fundamental bias or long-term direction is for these currencies. Let's quickly cross over. Now, if you look at your economic calendar, just even generally, the Forex factory that we're very used to, if you look at that, if you go to forexfactory.com, where you have the calendar, you can always see, if you scroll down a bit, you can see where interest rate is for each of the major economies. You can see that. currencies with the highest interest rate and the ones with the lowest interest rates. You can see it. The UK, New Zealand, and the US have the highest interest rates right now, around 4.75%. Japan and Switzerland have the lowest interest rates right now. Whenever you have the central bank meetings and they make adjustments to the interest rate, of course, that also pops up right here as well. So you can know. But you see, like I said, if you look at the stories around these central banks, the differences tell why they are behaving the way they are behaving. The US Central Bank, for example, I expected to cut interest rates in their next meeting in December. I think December, is it 12 or 17? I can't remember now. But then you have that. Now, of course, as markets expect them to cut the interest rate, it weakens the currency. But over the last couple of sessions, we've had expectation that they may not cut interest rates. As of this morning, the story is about 45% market do not expect them to cut interest rate, but leave the rates unchanged. That strengthened the US dollar even up to this morning. These are things that we look out for. And I'll quickly give you a glance on generally what the expectation is and the next meeting. This is a very good snapshot that traders can just look at and then use. The Bank of Canada, for example, the next move, they expected to cut interest rate in the next meeting. And by how much? By 0.25%. The probability there says how much do markets expect this to happen? And about 78% of those that have been measured expect them to do that, to cut the interest rate. The next meeting will be on the 11th of December, and then this is the current rate, and then you have it for the rest of them. So most of the major central banks right now are fully expected to cut interest rate. Most of them, the Bank of Canada, for the euro, the European Central Bank, for the US dollar, the Federal Reserve, for the New Zealand dollar, the Reserve Bank of New Zealand, and for the Swiss National Bank, for Switzerland franc, the Swiss National Bank. They are all expected to cut interest rate. And by how much is there? So, of course, you already know that by knowing that, as much as the probability increases in that light, the currency tends to behave in that particular direction. It's only the Bank of Japan that is going to increase or hike interest rates. Of course, the RBA, the Reserve Bank of Australia, is going to leave rates unchanged, same with the Bank of India. Now, currencies that the central banks are expected to cut interest rate, particularly if that probability is even higher, are expected to weaken against currencies where the central banks are expected to leave rates unchanged or even increase interest rate. But this view is a long-term view. Don't forget that markets don't move in a straight line, but this can give you an idea of where the overall direction is. So what do you do? So, for example, the Reserve Bank of New Zealand, right, expected to cut interest rate by 0.50%, and they have a high percentage for that. Now, as much as that continues to increase, before November 27th, which is next week, right, traders have been selling the New Zealand dollar. You too can also look into something like that. Against which currency? You look at the AUD, for example, where their central bank is expected to leave rates unchanged, and markets are 90% convinced about that. Of course, you expect AUD to rise in value against the NZD. These are the ways that you look at it. All right. So this is just a snapshot, just to give you an idea of what we look out for when we talk about central banks and monetary policies. And the interest rate, don't forget I said that when central banks are cutting interest rates, the value of the currency is expected to weaken. But when central banks are increasing interest rates, the value of the currency is expected to rise. But you must understand that this is a long-term view, and sometimes it takes longer to play out, but it can give you an underlying expectation of where that currency is likely to be. Now, there's a concept I want to explain to you before I go into some of the questions, right? And the concept is carry trade. Now, carry trade strategy is something that some traders also look into, but it's a long-term strategy. And you see, the difference between the interest rate among different currencies or countries can create opportunities for what we call carry trade. Carry trade is simply where a currency with a lower interest rate loses value over time compared to a currency with a higher interest rate. That is, if a currency has a lower interest rate and expected to continue to have a lower interest rate, far lower, that currency would over time lose value compared to a currency with a higher interest rate. That's what carry trade is. You see, traders can simply borrow money in the currency with a lower interest rate and invest it in currencies that have, or countries or currencies that have a higher interest rate. This is where that carry trade opportunity comes in. So, for example, historically, we've had Japanese yen maintain a low interest rate, and generally, Australia tends to maintain a high interest rate generally. So, you can expect that over time, the Japanese yen will lose value against the Australian dollar. Right now, the New Zealand dollar is a story where they have one of the highest interest rate, although they expect to cut rates. So, there's that part there. But if you look at that, compared to Swiss franc, the CHF has a lower interest, around 1%. You expect the New Zealand dollar to gain in value over time against the Swiss franc. So, as traders, this in itself can form trade ideas that we can also work with. These are things we're talking about. So, carry trade also is an opportunity. It's just that when it comes to CFD trading, you must understand that swaps are part of the story. Remember that in CFD trading, if you leave your trade running overnight, there's a cost that applies that we call swap. Although this is based on interest rates, but then you have swaps. At HFM, we have swap free on our trades, right? So for some of the instruments that you're trading for the first few days of your trades, up to 6 days in some cases, you don't get to pay or incur the swap. Or anything after that, you start to pay the swap. So my point is, if you're going to hold a trade running for a long time, you must consider swaps. Although if you're buying a currency with a higher interest rate and selling the one with a lower interest rate, the swap cost will be even lower or maybe even non-existent. But you must understand that swaps apply. So in general, interest rates are very important because they form the long-term direction for any currency or any asset. And the way you know what the interest rate is for any currency is through the central bank communication, the meetings, the statements, the press conferences, and the minutes of the meeting. Know that it's not until a central bank makes a tangible change to interest rate before there is a reaction. Sometimes just market expectation of what the central bank would be can be enough to drive price. Market expectation heading into the data release also, or the central bank meeting also forms trade ideas, and price tend to move in that particular direction. But you must understand that whatever the interest rate is, it forms the fundamentals, it forms part of the fundamentals or the long-term direction for any asset. When central banks are in a hiking circle looking to increase interest rates over time, the value of the currency tends to rise. But when the central bank is in a cutting circle looking to cut interest rates over time, the value of the currency tends to fall. To know what the central bank interest rate is at any time, of course, you can check the economic calendar or you can check out the central bank website to have that information. I hope this is clear. All right. I think I have answered. I'm trying to look at the questions that we have before our time is up and answer some of the questions that we can answer in the time that we have. Right. But very quickly, where can we always check? I think I've already shown us this, where we can find the interest rate. And I said on your economic calendar, you can find it there. And by extension, if you also look at when the central banks have their meetings as well, you can check the website or even the statement, you can as well find it there. Is there a video about this? Because the voice cuts and you didn't get some of this. Well, I think from my end, it's pretty clear. I don't think I have much complaints about, the sound from here, but this is recorded and it will be posted on our YouTube handle, HFM Nigeria. So you can catch that. By next week, it should be up. You can catch that and then you can, watch the video again. I think that can help. According to what you said, if the central banks are to cut interest rate, that means for that particular pair, we are to short it. I mean, cut means short and hike means buy. All right, we're on the same page. When the central bank is expected to cut interest rate or the cut interest rate or planning to cut interest rate even more, the value of the currency is expected to fall. So by short, you mean sell. Yes, traders can sell such currencies. If the central bank is looking to increase interest rates, of course, we expect the currency value to rise, and traders can as well buy such currencies. This one says, is there a video on swap or how to, I'm not sure how to swap. I don't mean how to swap. I'm not sure I get that. When we're talking about swap, yes, I'm sure we must have done, a video or two. Please check our YouTube handle, HFM. Just search HFM on YouTube and you can see some more information right there. Right? I don't have any other questions. Any other questions? Please, if you have any other questions from what we have learned today, please send them in and I can take to them. Please send them in and then we can take to them. But I want to believe that we have a clearer idea about what interest rate. It's just important that you have it somewhere at the back of your mind, right? When you're trading, when you know what the central bank is doing, you know where that currency is expected to go over time, and you can as well condition your trades in line with that. I hope that makes sense. All right. How do I use RSI effectively and efficiently in trading analysis? Well, this is not part of the scope of this class, but I think I can refer you to a specific video that we've done on this. Please, if you visit our YouTube handle, HFM, right, and just search, even HFM Nigeria, you can search HFM Nigeria and you search RSI there. We had a webinar on this earlier, and then you can always catch that and use that right there.